We are watching the White House right now as President Biden weighs in on those jobs numbers we got out this morning. Brian, 431 jobs, 31,000 jobs added in the month of March. That came in slightly lower than expectations, but we saw the unemployment rate falling to 3.6%. And of course, the big question is, how does this set things up for the Fed?
Yeah, and that's not far away from the 3.5% 50-year lows that we had seen prior to the pandemic in the beginning of 2020. But a lot of other interesting data to look at, obviously wage growth being examined in the context of inflation. But it's interesting to see compositionally who is driving a lot of these employment gains. And you got to highlight the job that women are doing in terms of driving a lot of this activity. When you consider the just total raw amount of people that were employed on a month-over-month basis, we saw larger gains among women than we did actually among men between February and March. And we also saw some interesting statistics on the people who currently want a job, which could be seen in some cases as a leading statistic for future months' job gains. And we had seen 5.7 million people mark on the survey that they are looking for a job. That's the largest increase month over month since November of 2020. So, Akiko, for those concerned about whether or not there's going to be some sort of downturn in the jobs gains, at least this statistic showing you that maybe we can still see some pretty solid job numbers in April, May, and perhaps beyond.
And Brian, you mentioned the labor force participation rate largely unchanged. It did climb to 62.4, so a slight improvement there. But you get the sense here that some of the constraints that have kept potential employees, potential workers out of the workforce are starting to look for, have largely been removed. Looking at the survey from the Census Bureau that was out recently, roughly 2.8 million people saying they weren't working because they had to care for somebody with COVID in the month of March, but that is still about 6 million less than what we saw back in January. So it feels like things are moving in the right direction.
Yeah, I mean, this is kind of a weird situation where it's not necessarily as binary as, well, job gains is a good thing within the context of this recovery. Of course, we want as many people that are on the sidelines to come back into the economy. But we know that the wage pressures that we're seeing in the labor market are increasingly coming into focus with the Federal Reserve's concerns about this feedback loop of a wage price spiral. And one tweet, I think, from Elizabeth Pancotti that we saw online kind of underscores the weirdness of whether or not to read positively or negatively the jobs numbers when you note that economists have been saying, look, we need tight labor markets, and then labor markets, they get tight, as we're seeing right now, unemployment at 3.6%. And then economists go, oh, great heavens, no, right? So when we kind of reference Bubba Sparks here, get it right, get it tight, it's not always good within the context of the larger issue that we know Americans are feeling right now, which is rising prices. Now, again, that feedback cycle is still up for debate whether or not it's happening right now, but that's going to be the debate that we should expect to continue to have into those April, May, June jobs reports.
Let's bring in our first guest for the hour, Brian. Lindsay Piegza is a chief economist at Stifel. And Lindsay, you're listening to Brian's analysis of this, but I wonder what stood out to you in the numbers we got out this morning.
Well, it was certainly a strong report. The headline number over 400,000 reinforces the Fed's assessment of a solid labor market. And I think this adds further justification for the Fed's new aggressive pathway to higher interest rates in order to rein in inflation. And in fact, as we heard from the chairman, 25 basis point steps may not be enough. We may see a 50 basis point step come May as inflation remains at a multi-decade high and employment remains robust, for lack of a better word.
Hey, Lindsay, Brian here. I mean, what else stood out to you in the report when we take a look at things like, for example, employment to population ratio, the labor force participation rate, because there was a lot of chatter about how much further you could improve those statistics.
I think the labor force and participation rate was actually a good positive indicator of where we're headed going forward. Remember, we still have millions of Americans sitting on the sideline for a variety of reasons, as you were mentioning, whether that's elder care issue, child care issues, a lingering stockpile of wealth, or ongoing concerns about the virus. Many of these variables are improving, and that's reducing the incentive to remain on the sideline. So as these workers slowly come back in. We're going to see that demand for workers, the 11 million vacancies currently in the marketplace, slowly filled. And this should provide additional balance to the labor market going forward. Now, of course, that's a longer term projection. But again, this is a small step in the right direction to a more sustainable pathway longer term.
Lindsay, we were just talking about the yield curve inverting earlier, and I'm looking at your notes here. You say the risk of a recession has jumped to well over 50%, at least over the next 21 months. What are the warning signs you're seeing?
I think right now the warning sign is the commentary from the Fed, the projections from the Fed, raising rates potentially an additional 6 times this year against the backdrop of a U.S. economy that's still very moderate. Remember, the Fed typically is raising rates when the economy is overheating. And by increasing the cost of capital, we tap down consumption, tap down investment, and the economy slows and inflation comes in at a more benign level. This time around, however, we're looking at GDP numbers shaping up for the first quarter to be around 1%. So this is hardly an overheating economy. So when we simply look at the shape of the economy, the structure of the economy at this point, against the backdrop of a Fed that is very much positioned to raise rates aggressively, I think the outcome, it's hard to deny, will be monetary policy choking off domestic growth, potentially then forcing us into recession.
So if that's the baseline scenario, what happens after that? Because I don't want to get too much into the nuances of the yield curve, but even though some people might be saying, yeah, well, some of the Fed's dynamics are at play behind the flat/inverted yield curve, it does give a pretty good signal that there's a real risk of the Fed having to eventually cut interest rates to then re-steepen the curve at some point.
I don't think we're at the point where we can talk about the Fed hiking and then giving us back some of that, some of those rate cuts. But I do think that when we look out to the longer term pathway for inflation, if we start to see some of that organic balance return to the marketplace as a result of supply chain disruption smoothing, or we see resolution overseas, that may actually remove some of the need for the Fed to be quite as aggressive as they've laid out. And so we may see the Fed actually stop short of what the Fed has projected. And that would allow maybe not a soft landing. I think that's a bit of a utopic scenario, but maybe not quite as an aggressive recession as the market may otherwise be pricing in if the Fed did follow through with a very aggressive pathway, getting us potentially to 3% in 2023.
Yeah, and as a reminder, the next Federal Reserve meeting isn't for another 4 weeks, so a lot can happen between now and then. But Lindsay Piegza, Stifel Chief Economist, thanks so much for stopping by. Have a great weekend.